Most people hear the words Strait of Hormuz and do the same thing. They nod, they scroll, they file it away under geopolitical noise and move on with their day. That instinct, that habit of treating a headline as background, is precisely what costs them. Because the Strait of Hormuz is not a headline, it is a lever, and when it moves, the entire global financial machine moves with it. I want to tell you something uncomfortable before we go any further. The most dangerous market events in history did not arrive with warning sirens. They arrived looking like ordinary news, a small phrase, a wire report, a regional tension that analysts are monitoring. And then, without announcing itself, the system shifted. Prices are repriced. Wealth moved, and the people who were paying attention were positioned on the right side of history. Everyone else was still nodding and scrolling. What I'm going to do in this script is show you a machine, not a conspiracy, not a prediction, a machine. A repeating, historically documented, structurally inevitable machine that activates when three conditions collide: extreme debt, an energy shock, and policymakers who cannot afford to tell the truth. If Hormuz risk escalates into even partial disruption, not a full blockade, just elevated uncertainty, gold and silver do not gradually drift upward. They reprice violently. They can gap. And I'm going to show you exactly why that is not an opinion. It is a consequence of how the system is built. Here is the thesis in its most unvarnished form. The global financial system is running on promises, not production, and promises are catastrophically fragile the moment the real world stops cooperating. Let me give you two numbers that anchor everything that follows. Global debt, as tracked in recent IMF reporting, sits somewhere around $250 billion. That number is so large it loses meaning in the abstract. So let me make it concrete. It is well above 200% of total world economic output. That means for every dollar of goods and services the entire planet produces in a year, there are $2 of debt demanding service, demanding payment, demanding trust. The world is not powered by savings. It is powered by confidence that those promises will be honored. Now add the second number. Roughly 1/5 of global petroleum liquids consumption passes through the Strait of Hormuz in a typical year. One corridor, one choke point. 1/5 of the master input that keeps factories running, trucks moving, crops fertilized, ships rerouted, and inflation contained. When that corridor carries a risk premium instead of certainty, it doesn't just push oil prices higher, it sends a tremor through every system that depends on stable energy inputs, which is every system. Here's what I want you to hold in your mind as a kind of open question, a thread I will pull through everything we discuss. The biggest move in precious metals is never caused by oil itself. The biggest move is caused by what oil forces policymakers to do next. Remember that. We'll come back to it. Now let me give you the architecture, a four-stage pattern that repeats across centuries, regardless of the technology available, regardless of who is in power, regardless of what the dominant ideology claims about itself. I'm going to name these stages, and then I'm going to prove them 3 times with historical case studies before applying the pattern to the present moment. The first stage is the setup. A society has a functioning unit of account. People trust that money today will still resemble money tomorrow. They plan decades into the future. They take long-term loans. They invest. They build. Setup isn't perfect. Setup is confidence, the quiet foundation that lets complex civilization operate. The second stage is expansion. The state grows its commitments. The private sector grows its leverage. Debt begins to outpace real output. This is not immediately alarming to anyone inside the system, because during expansion, growth feels real. Living standards rise. Credit flows. Prices are stable enough. The system becomes addicted to one idea, that pain can always be postponed. Liquidity becomes a substitute for productivity, and the future begins quietly funding the present, while everyone inside calls it progress. The third stage is crisis. A real-world constraint appears. Not a financial variable, not a policy error, a physical constraint, something that cannot be printed, cannot be eased away, cannot be managed with language. A war, a supply disruption, an energy shock, a geopolitical choke point that stops behaving like it's supposed to. The shock exposes that the promises built during expansion are larger than the real resources available to honor them, and policymakers discover they are holding a menu with no good options. The fourth stage is the outcome. Faced with that menu, systems historically choose the path that postpones visible pain, currency dilution, negative real interest rates, financial repression, managed inflation that is condemned in public and tolerated in practice. The unit of account loses purchasing power, and in that environment, the assets that are no one's liability, gold first, silver with higher volatility, get repriced. Sometimes gradually at first, then, when confidence cracks, abruptly, that is the machine. 4 stages. setup, expansion, crisis, outcome. Now let me prove it doesn't just happen once. The first proof is Rome, and Rome matters because it gives us the cleanest, longest, most undeniable version of the machine running from start to finish. Rome's early imperial system had extensive trade networks, strong administrative reach, and coinage with real metal content. The currency worked because citizens and merchants alike believed it represented something. Actual silver, actual gold, backed by actual power. That is, the setup. As Rome's obligations grew, armies to pay, borders to defend, political legitimacy to purchase through public spending, leaders faced a menu that has not changed in 2,000 years. Raise taxes and risk revolt, cut spending and risk instability, or adjust the currency quietly, a little at a time, and call it administration. Rome chose the third option. The denarius was gradually reduced in silver content across successive emperors and periods. No single emperor destroyed the currency. The machine did it incrementally, because each individual debasement made the next one more necessary. That is expansion converted to crisis. Here is the feedback loop that makes it irreversible. As debasement continues, prices rise. Soldiers demand more coins to buy the same provisions. Suppliers demand more coins to cover rising costs. Tax receipts lose real value even as the state's obligations rise in nominal terms. The currency weakens. Obligations grow harder to meet. The state debates further to meet them, which weakens the currency further, which makes obligations harder to meet. It is a trap with no painless exit. People, acting rationally, begin hoarding real goods. They move wealth out of the currency system. They seek assets that hold value outside the promise network. The price of metal relative to debased coin explodes, not because metal became more valuable in absolute terms, but because the measuring stick became less reliable. Rome teaches the first fundamental lesson. When obligations outrun resources, the currency becomes the battlefield. The second proof is Weimar Germany, and Weimar matters because it shows what happens when that battlefield becomes a rout. Germany before the First World War was a serious industrial economy. Factories, exports, sophisticated finance, genuine productive capacity. That is the setup. The war converted that capacity into destruction while simultaneously converting future promises into present expenditure. Governments cannot fund modern war through taxation alone, so they borrow and print. The war ends. The productive capacity is damaged. But the obligations do not end with the armistice. They transform. Reparations, political fragmentation, and social pressure create a situation where leaders feel they cannot impose the necessary pain directly. The Treaty of Versailles became a constraint that shaped every economic decision made afterward. That is expansion under maximum stress, sliding into crisis. As the government printed to meet obligations, confidence began to erode. And here is the psychological mechanism that turns inflation into a stampede. Once people genuinely believe that prices will be higher tomorrow than today, they spend immediately. They convert currency into goods with any real utility. That accelerates the velocity of money, which accelerates price increases, which confirms people's fears, which accelerates spending again. It is exponential, not because inflation is linear, but because confidence is not a linear variable. It is a threshold variable. And once it crosses the threshold, the system does not slow down. It runs. Weimar's currency did not gradually decline. It collapsed. By the time ordinary citizens accepted that money was failing, the system had already passed the point of repair by normal means. Real assets became lifeboats. Foreign currency circulated alongside the domestic collapse. Gold became money again, not as tradition or sentiment, but as the only reliable signal left in the wreckage. Weimar teaches the second lesson. When confidence flips, repricing is not a trend. It is discontinuous. It jumps. The third proof is the United States in the 1970s, and this one matters most for our purposes because it is the closest structural parallel to the present moment, complete with an oil shock through a geopolitical choke point. After World War II, the U.S. anchored the global financial system through Bretton Woods. The dollar was linked to gold for foreign governments. American industrial dominance was real and enormous. The world held dollars because dollars represented both stability and convertibility. That is the setup, arguably the most powerful monetary setup in modern history. Over the following decades, U.S. commitments expanded. Domestic programs, military spending abroad. Foreign governments accumulated more dollars than U.S. gold reserves could plausibly back. The promise became mathematically implausible. In 1971, President Nixon closed the gold window. This was not a minor policy adjustment. It was a regime change, from external discipline backed by metal to internal discretion backed by trust. That is the shift from expansion to fragility. Then the oil shocks hit. The 1973 OPEC embargo, The 1979 energy crisis. Energy costs surged into an economy and a world that had been engineered on the assumption of cheap, reliable oil. Inflation rose sharply, growth slowed simultaneously, stagflation appeared. And stagflation is the policymaker's nightmare precisely because the two available tools point in opposite directions. Tighten monetary conditions to fight inflation, and you risk breaking growth and credit. Ease conditions to support growth, and you feed the inflation you're supposed to be controlling. There is no clean answer. There is only a choice between two kinds of pain. The outcome, hard assets repriced dramatically. Gold, now free-floating after the Bretton Woods regime ended, became a real-time scoreboard for monetary credibility. Silver moved with even greater volatility, amplifying the signal with speculation layered on top. The era ended only after Paul Volcker imposed credibility through painful tightening beginning in 1979, accepting a deep recession to re-anchor inflation expectations. The U.S. case teaches the third lesson. When an energy shock collides with monetary discretion, precious metals become the truth serum of policy. They say in price what policymakers cannot say in words. 3 case studies, 3 different centuries, 3 different technologies, 3 different political systems, the same 4-stage machine. Now apply it to the present, not with fear, but with precision. The setup is visible if you know where to look. For decades, the world optimized for efficiency rather than resilience. Supply chains were stretched across oceans and oceans alone. Inventories were stripped down to just-in-time religion. Cheap energy was not a policy. It was an assumption built into every model, every price, every business plan. And central banks trained financial markets to expect intervention whenever volatility appeared. Risk was supposed to be manageable. Someone would always step in. That psychological foundation, that promise of a backstop, is the setup for the present cycle. The expansion is not debatable. Debt grew faster than output for decades across governments, corporations, and households. Deficits were normalized. Refinancing became a permanent operating condition rather than an emergency measure. When debt reaches the scale it has reached, the entire structure becomes extraordinarily sensitive to 2 variables: interest rates and input costs. Not sensitive like uncomfortable, sensitive like fragile. And fragility changes everything about how policymakers behave. Because in a fragile system, you cannot accept short-term pain without risking cascading consequences that are immediate, visible, and politically lethal. Now bring in Hormuz, not as a geopolitical story, but as a system stress test. If roughly 1/5 of global petroleum liquids consumption moves through that corridor, then the corridor carries more than oil. It carries certainty. It carries stable shipping insurance. It carries reliable delivery schedules that let factories plan, businesses price, and governments project budgets. When that certainty becomes uncertain, prices do not need a full blockade to react. Markets price risk premiums on probability, not on confirmed disaster. Insurance prices. Shipping routes divert. Inventory behavior changes as companies hedge against disruption. Countries accelerate strategic reserve drawdowns. The system begins acting like it is in danger before it actually is. And that behavioral shift, that anticipatory panic, is itself inflationary. Now trace the chain reaction that most people never follow all the way through, because it's invisible until it isn't. Oil spikes, even partially. Diesel rises. Every truck on every road in every country that uses diesel carries a higher operating cost. Freight rates rise. Food distribution costs rise. Fertilizer and petrochemical input costs rise. Consumer prices at every level of the supply chain rise. Households feel it in days, not quarters, not in earnings reports, not in analyst revisions, but at the gas station, the grocery aisle, the utility bill. Wage demands follow. Corporate margins compress. Businesses cut hiring. Credit risk rises across the system. And in a debt-saturated world, rising credit risk is not a normal cyclical adjustment. It is a trigger that can cascade, because the promises that hold the system together were written assuming that credit risk stays contained. This is where the central bank trap closes. If inflation rises because oil rises, conventional policy says tighten, raise rates, slow demand, cool prices. But if you tighten aggressively into a supply shock while the system is leveraged at historic levels, you risk breaking credit markets, housing affordability, corporate debt refinancing, and government debt service simultaneously. So policymakers face 2 options, and neither one is acceptable. Tighten hard and risk insolvency cascades. Ease or hesitate and risk currency erosion. There is no path that avoids pain. There is only a choice of which pain and when. Historically, systems choose the path that postpones visible pain. They lean toward financial repression, keeping nominal conditions accommodative relative to inflation, guiding expectations with careful language. tolerating inflation in practice while condemning it in rhetoric. The result is negative real rates, inflation running above what savers and bondholders actually earn. Their wealth erodes quietly while officials speak reassuringly, and negative real rates are precisely the environment where gold tends to perform, because the opportunity cost of holding a non-yielding asset falls to zero or below, while the demand for anything outside the promise system rises sharply. Silver follows, but differently. Gold is the monetary signal. Silver is the volatility amplifier. Gold moves when the sophisticated money recognizes the regime shift. Silver moves harder when the crowd finally believes it, because silver's market is thinner, more speculative, and more emotionally driven. The lag between gold's initial move and silver's surge is not a bug. It is the emotional timeline of a crowd moving from skepticism to conviction. Now the gap, because this is where people genuinely misunderstand the risk they face. A gap is not a mood. A gap is a liquidity event. In normal markets, price discovery is continuous because there are bids and offers stacked at many levels. Buyers and sellers are always present. In crisis conditions, liquidity retreats. Market makers widen their spreads dramatically. Futures markets reprice during off hours when participation is thin. News breaks at 2 a.m. when half the desks in the world are dark. The transition from one price equilibrium to the next happens faster than the market can fill in the middle. That is a gap, and it is why "I'll buy when things get clearer" is often a sentence that costs people the move entirely. If Hormuz risk escalates in a single overnight session, you can see oil jump, inflation expectations jump, real yields drop, and gold and silver reprice before most participants have even processed what happened. Now I promise to close the open loop. Oil is not the story. Policy is. There is one sentence that signals the regime has changed. You will hear it from a central banker or a finance minister, and it will sound reasonable. It will sound measured. It will sound like wisdom, and it is the most revealing thing they can say. We must balance the fight against inflation with the need to support growth and financial stability. When financial stability appears alongside inflation control in the same sentence from a policymaker, you are being told something explicit. The system is fragile enough that protecting its structural integrity is now competing with protecting your purchasing power. Those two goals are not aligned, they are in tension. And when the system has to choose, as it always eventually does, financial stability wins, because the alternative is an immediate, visible crisis rather than a slow, deniable erosion. That is the fork, and precious metals are how the market votes on which side of the fork the system is actually standing. There are 3 myths that stop people from seeing this clearly, and I want to kill all 3 before we finish. The first myth: this can't happen here because we're different. Different does not erase arithmetic. The difference does not change what happens when debt outgrows resources and a real shock arrives. Different is a comfort, not a shield. The second myth: technology will solve this quickly. Technology is a long-run force. It cannot instantly reroute energy flows around a closed choke point. It cannot remove a geopolitical reality in a news cycle. It does not stop the immediate repricing of risk when uncertainty arrives. Over decades, yes. Over the days and weeks of a developing crisis, no. The third myth: it's already priced in. This is the most seductive myth because it sounds sophisticated, but market price probabilities. When probabilities shift sharply, when a tail risk moves from background noise to front-page reality, prices jump to reflect the new distribution. That jump is not priced in. That jump is the pricing in happening in real time, faster than most people can react. So here is what to actually do with this. Practically, personally. Think in stages, not headlines. Before reacting to any news, ask yourself, where in the 4-stage cycle is the system right now? Setup, expansion fragility, crisis, outcome. Naming the stage removes the noise and clarifies the stakes. Watch the signals that precede repricing. Oil flow data, shipping insurance rates, freight indices, inflation expectations embedded in bond markets, real yields, and above all, the language shift from price stability to financial stability in official communication. If you choose exposure to precious metals, understand what you are holding and why. Gold is a hedge against the outcome, against the scenario where policymakers choose erosion over confrontation. Silver is a high volatility companion that can amplify gains dramatically, but will also punish impatience. Confusing those two roles, treating them interchangeably, is how people get hurt in exactly the market they thought would protect them. And do not wait for consensus. In a system where the repricing can gap, the cost of being early is emotional discomfort. The cost of being late is paying the new equilibrium price on the other side of a move that has already happened. Here is the final structural truth, and I want you to feel its weight. A debt-saturated global system cannot absorb a prolonged energy shock without choosing between 2 forms of pain: defaults, austerity, and visible crisis, or currency dilution, negative real rates, and quiet erosion. History shows which option is chosen first, because one is politically survivable and one is not. That is not cynicism. That is pattern recognition across millennia. The Strait of Hormuz is not a geopolitical story. It is a trigger, a real-world constraint capable of forcing the monetary system to reveal its actual priorities. And when those priorities shift from protecting your purchasing power to protecting the structure itself, gold becomes the scoreboard and silver becomes the amplifier. The machine does not announce itself. It does not ask for your attention. It runs according to its own logic, on its own timeline, indifferent to whether you understand it or not. But understanding it, really understanding it, changes what you see when the next headline scrolls across your screen. So when you see Hormuz tensions, do not nod and scroll. Ask what stage we are in. Ask what policymakers will be forced to do next. Ask who is positioned to survive the outcome, and who is still waiting for clarity that will arrive too late. The next episode goes deeper into the hidden architecture, how debt cycles, energy dependence, and policy discretion interact to create a repeating pattern that most people only recognize after it has already broken them. Stay with it. Because the next stage does not announce itself politely. It arrives, it reprices, and then it asks who was paying attention.